Welcome to Belhaven University Lectures. What you are about to hear is a podcast based on course material selected by the course developer. It was generated by Google Notebook LM, a generative AI. Please contact your instructor if you have any questions related to the content. Okay, let's get started.
Welcome to this deep dive from Belhaven University Lectures.
Today we're diving into the interesting world of tax credits, how they affect your financial life, and we'll also look at property transactions.
Right, and we'll touch on the alternative minimum tax, AMT, and some payment procedures too. Think of it as getting a practical handle on these areas, which can often seem pretty complex.
Exactly.
Okay, let's get started.
So, tax credits, let's start there. They're really fascinating tools, aren't they?
Yeah.
Governments use them to, achieve certain goals, social, economic, and environmental.
And promoting fairness, you mentioned.
Yes, and promoting fairness among taxpayers, too. That's a key aspect.
Okay, so why do they exist? What are those big picture goals?
Well, like I said, they're multifaceted. They might push social aims, maybe incentivizing something like adoption or supporting families. Economically, maybe they want to spur business investment or create jobs. Environmentally, you see credits for things like renewable energy.
Right.
And fairness, providing targeted relief where the government thinks it's needed.
That makes sense. Now, you often hear tax credits and tax deductions thrown around. Sometimes people mix them up. What's the core difference?
That's a really important distinction. The main thing is how they affect your tax bill. A deduction, it lowers your taxable income.
Okay.
So the actual dollar value of that deduction depends on your tax rate. A $1,000 deduction is worth more to someone in a higher tax bracket.
Right, because it reduces the income being taxed at that higher rate. So how do credits differ?
Credits are more direct. A tax credit reduces your actual tax owed dollar for dollar. So a $1,000 tax credit. It cuts your tax bill by exactly $1,000 no matter your tax bracket. Remember that example with Abby, Bill, and Carmen?
Yeah.
If they each spent $1,000 and got a 25% credit, they each save $250 on their taxes. Same benefit for everyone. If it was a deduction, the savings would vary based on their tax rates. That direct reduction is key for credits.
That's very clear. Now, I know credits aren't all the same. There are refundable and non-refundable ones, right?
Exactly. Another crucial difference. Refundable credits are interesting because they can actually give you a refund even if the credit is more than the tax you owe.
So you could owe zero tax but still get money back.
Precisely. Think about taxes withheld from your paycheck. If those withholdings plus your refundable credits are more than your total tax, you get the difference back.
Okay. What are some examples?
Well, the withheld taxes themselves. Part of the child tax credit is refundable, the earned income credit is a big one, and the ACA premium tax credit. These can mean a check from the government.
Got it. So non-refundable credits must be the opposite.
Right. Non-refundable credits can only reduce your tax liability down to zero. If the credit is more than you owe, you generally lose the excess.
Generally. Are there exceptions?
Yes, some non-refundable credits, like the general business credit we'll talk about, might have carryover rules. So you don't necessarily lose the excess immediately. You might be able to use it in a future year.
And what falls under non-refundable?
Oh, lots of them. The general business credit itself, credits for the elderly or disabled, the foreign tax credit, adoption expenses, the dependent credit part, child care expenses, education credits, energy credits. The list goes on. They reduce your tax, but not below zero.
You mentioned the general business credit. That sounds like an umbrella term.
It is, yeah. It basically bundles together a whole bunch of different business-related credits.
Like which ones?
Things like the credit for rehabilitation expenditures, work opportunity credit, R&D credit, low-income housing, disabled access, many others. Each has its own rules, but they get grouped together, and the total general business credit you can take in 1 year has its own limits, often tied to your income tax or tentative minimum tax.
And you mentioned carryovers.
Right. If you can't use all of your general business credit in 1 year, you can usually carry it back 1 year and then forward for up to 20 years. It follows a FIFO first in, first out method, so businesses can benefit even without high tax liability in a given year.
Okay, let's zoom in on a few of those. The tax credit for rehabilitation expenditures. What's the goal there?
It's a couple of aims. One, discourage businesses from just leaving older areas for new developments. 2, really encourage preserving historic buildings.
How does it work?
Typically, it's a 20% credit on the qualified costs you spend rehabbing a certified historic structure, residential or non-residential.
Okay.
You usually take the credit over 5 years, starting when the building is back in service. And importantly, your tax basis in the property gets reduced by the credit amount.
You said qualified costs. Does everything count? And what's substantial rehabilitation?
Good questions. No, not everything counts. Buying the building itself or costs for things like parking lots or making the building bigger, those usually don't qualify. And substantial rehabilitation means your qualified spending over a 24-month period has to be more than the building's adjusted basis before you started, or $5,000, whichever is greater. It ensures it's a significant project.
Got it. What about the work opportunity tax credit? How does that encourage hiring?
It gives employers a credit for hiring people from specific groups that often face hurdles finding jobs.
Like who?
Various groups, veterans, ex-felons, people receiving certain types of public assistance, long-term unemployed, and others defined by the law.
And the credit calculation.
It applies to the first $6,000 of wages paid in the first year of employment. The rate is usually 40% if the employee is certified and works at least 400 hours.
And if they work less?
If they're certified and work between 120 and 399 hours, the credit is 25%. And remember, the employer has to reduce their wage deduction by the amount of the credit. No double dipping.
Makes sense. Let's switch to innovation, the research activities credit, or R&D credit. That's meant to spur research, right?
Absolutely. It's designed to encourage companies to invest in discovering technological information for new or improved products or processes.
How is it structured?
It actually has 3 parts: an incremental credit, a basic research credit, and an energy research credit.
Does all research qualify?
No, there are exclusions. Research after commercial production starts, market research, quality control testing, research done outside the U.S., or social science humanities research. Those generally don't count. It's focused on technological R&D.
Okay, so how's that main incremental credit figured out?
The standard way is it's 20% of your qualified research spending for the year that's over a calculated base amount.
And the base amount relates to past spending?
Yes, it's usually based on your historical spending and revenue. Qualified spending includes in-house costs like wages and supplies, and also 65% of what you pay third parties for contract research.
Is there a simpler way?
There is. It's called the simplified credit. That's 14% of your current year's qualified research expenses that exceed 50% of your average spending over the prior 3 years.
And again, no double benefit with deductions.
Right. You either have to reduce your R&D expense deduction by the amount of the credit, or you can choose to take a slightly reduced credit amount. Companies need to figure out which is better for them.
What about the basic and energy research parts?
The basic research credit gives an extra 20% for payments for basic scientific research, think advancing knowledge, without a specific commercial goal that exceed a base amount. Again, usually not for research outside the U.S. or in social sciences. The energy research credit is also 20%, but specifically for payments to energy research consortiums doing energy research. These are trying to target specific innovation areas.
There are also credits related to housing, like the low-income housing credit.
Yes, that's a big one for encouraging affordable rental housing development. It's complex because it depends a lot on non-tax factors like how many units are rented to low-income tenants.
How's the credit itself work?
It's based on the property's qualified basis and claimed over 10 years. But there's a catch potential recapture if the property stops meeting the low-income requirements during that period. It's a critical piece for financing affordable housing.
And for businesses making their places more accessible for people with disabilities, is there help for that?
Yes, the Disabled Access Credit. It's for eligible small businesses.
Small businesses, okay.
Right. It helps cover costs to make facilities accessible, especially older buildings put in service before November 1990. The credit is 50% of eligible costs between $250 and $10,250.
So a maximum credit of $5,000?
Exactly. $10,250 equals $10,000, and 50% of that is $5,000. And like the rehab credit, the property's basis is reduced by the credit amount.
Makes sense. We hear a lot about clean energy. Are there business credits for that?
Definitely. There's a whole suite of energy credits for businesses promoting solar, wind, carbon capture, clean fuels, you name it.
And these were boosted recently.
Yes, the Inflation Reduction Act significantly modified or expanded many of them. A key feature now is that many credits can be 5 times larger if the project meets prevailing wage and apprenticeship requirements.
Wow, 5 times.
Yeah, it's a big incentive. Plus, there's often a bonus, maybe 10% if they use domestic steel, iron, or manufactured components, really pushing U.S.-based clean energy projects.
Shifting gears to employees' credits for small employer pension plans.
Yeah.
And childcare.
Yes. To encourage small businesses, fewer than 100 employees earning at least $5K to start retirement plans, there's a credit. It's 50% of startup costs.
What's the limit?
It's capped at the lesser of $5,000 or 250 times the number of non-highly compensated employees eligible for the plan. The deduction for those costs is reduced by the credit. There might even be an extra bit after 2022 for employer contributions.
Okay, and the childcare one?
That's the credit for employer-provided childcare. Employers can get a credit up to $150,000 a year. It's 25% of costs for running a childcare facility for employees, plus 10% for resource and referral services.
Basis reduction again.
Yes. Deductible expenses and the basis of any facility are reduced. And there's potential recapture if the facility stops being used for childcare within 10 years. Both credits aim to support employee benefits.
What about the credit for employer-provided family and medical leave? I heard that one might be temporary.
That's right. It's currently set to expire after 2025. It allows eligible employers a credit, starting at 12.5% of wages paid to employees while they're on qualified family and medical leave.
What makes an employer eligible?
They need a written policy providing at least 2 weeks of paid leave for full-time employees, prorated for part-time, and the pay during leave must be at least 50% of the employee's normal wage.
And the credit rate can go up.
Yes, the 12.5% increases by 0.25 percentage points for every percentage point. The wage replacement rate exceeds 50%, but it's capped at 25%. The credit is also limited to 12 weeks of leave per employee per year.
Okay. Let's go international, the foreign tax credit. Who gets this and why?
Individuals and corporations can claim it. If you pay income tax to a foreign country on income that's also taxed by the U.S., this credit helps prevent double taxation.
So you're not taxed twice on the same earnings.
Exactly. You generally have a choice. Take a credit or a deduction for those foreign taxes. The credit is usually better because it directly reduces your U.S. tax, rather than just reducing taxable income.
Are there limits?
Yes, definitely. You can't claim a credit for more foreign tax than you actually paid. And there's a formulaic limitation based on your foreign source income relative to your worldwide income. Basically, the credit can't exceed the U.S. tax you would have paid on that foreign income.
What if the limit applies?
Unused credits can be carried back 1 year and then forward for 10 years. And crucially, this is only for income taxes, not things like VAT, severance taxes, property taxes, or sales taxes paid overseas.
Got it. Let's pivot to individuals now. The Earned Income Credit, or EIC, is a really important one for many people.
Absolutely. It's targeted at working individuals and families with low to moderate incomes. Eligibility and the amount depend heavily on your earned income wages, self-employment earnings, and how many qualifying children you have.
Can you give us a rough idea of the amounts for 2024?
Sure. For 2024, a married couple filing jointly with, say, 1 child, the max credit is around $4,200. With 2 kids, it's nearly $7,000. 3 or more, it can top $700-800.
So it increases with children?
Yes, up to 3. The exact amount uses a formula based on income and a percentage, and it phases out once your income, or AGI, goes above certain levels, which depend on filing status and number of children.
What if you don't have kids?
There's also a smaller EIC available for workers aged 25 through 64 who don't have qualifying children and aren't someone else's dependent. The amounts and phase-outs are lower, but it's still valuable support.
Okay. Then there's the child tax credit and the dependent tax credit. How do those work?
Right. The child tax credit is $2,000 for each qualifying child under 17. They need to be your dependent and a U.S. citizen.
And the dependent credit?
That's $500 for other dependents who don't qualify for the child tax credit. Maybe an older child or an elderly parent you support.
Are there income limits?
Yes. These credits phase out at higher incomes. The phase-out starts at $400,000 AGI for married couples filing jointly and $200,000 for others. The credit drops by $50 for every $1,000 your AGI is over those thresholds.
Is any part refundable?
Yes, part of the child tax credit is. For 2024, up to $1,700 per child can be refundable, but that's limited by your earned income, specifically 15% of earned income over $2,500. The $500 dependent credit is not refundable.
And these amounts might change.
They are scheduled to, yes.
Oh.
Under current law, after 2025, the child tax credit is set to drop back to $1,000, and the dependent credit would be eliminated. So that's something to watch.
Childcare costs are huge for many families. Is there a credit for that?
Yes, the credit for child and dependent care expenses. This helps with costs you pay so you and your spouse, if married, can work or look for work.
Who qualifies for care?
A dependent child under 13 or a spouse or dependent who is physically or mentally unable to care for themselves and lives with you more than half the year.
How much do the expenses count?
Up to $3,000 for one qualifying person or $6,000 for two or more. The credit is then a percentage of those expenses.
What percentage?
It ranges from 35% down to 20%. The percentage goes down as your AGI goes up, starting to phase down once AGI exceeds $15,000.
Are there other limits?
Yes, the expenses can't be more than your earned income or the lower earning spouse's income if married. There are special rules if one spouse is a student or disabled. And if your employer provides dependent care benefits, you have to subtract those from the expenses you claim for the credit.
Okay. Education is another big expense. What credits help there?
Two main ones, the American Opportunity Credit, AOTC, and the Lifetime Learning Credit, LLC.
Let's start with the AOTC.
Okay. Max credit is $2,500 per student per year, but only for the first 4 years of college or post-secondary education.
How was it calculated?
It's 100% of the first $2,000 you pay for tuition, fees, and required course materials, plus 25% of the next $2,000.
So you need $4,000 in expenses to max it out.
Right. The student also has to be enrolled at least half-time, pursuing a degree or credential. And there are income limits it phases out between $80K and $90K modified AGI for single filers, $160K to $180K for joint filers.
Is it refundable?
Partially. Up to 40% of $1,000 is refundable. And it can offset the alternative minimum tax, which is helpful.
Okay, how does the lifetime learning credit compare?
The LLC is different. It's 20% of up to $10,000 in qualified expenses, so the max credit is $2,000 per tax return, not per student.
Per return.
Right. And it's not limited to the first 4 years or require half-time enrollment. It can be used for courses to acquire or improve job skills, too. It mainly covers tuition and fees, not usually books unless required to be paid to the institution.
Same income limits.
Yes, same phase-out ranges as the AOTC. But the LLC is not refundable, and it cannot offset AMT. Also, you can't claim both the AOTC and LLC for the same student in the same year. You have to choose.
Good to know. What about making your home more energy efficient? Any credits for homeowners?
Yes, a couple there too. First is the Energy Efficient Home Improvement Credit. This gives you 30% back on certain energy efficiency upgrades.
Like what?
Insulation, energy efficient windows and doors, certain heating cooling systems, even home energy audits.
Are there caps?
Yes, there are annual limits on specific items like $600 for windows, $500 for doors, $150 for audits. The total general annual limit is $1,200, but it can go up to $2,000 for certain things like heat pumps or biomass stoves.
Refundable. Carryover?
No, it's non-refundable and no carryover for unused amounts. You use it or lose it each year.
Okay, what's the other one?
That's the Residential Clean Energy Credit. They get renewable energy items. Think solar panels, solar water heaters, geothermal heat pumps, small wind turbines, battery storage.
Any limits there?
The credit percentage itself is the main thing. Unlike the home improvement credit, there isn't a fixed dollar cap on the total cost of the system. But the 30% rate is scheduled to drop in 2033 and 2034 and then expire.
Can you carry this one forward?
Yes. If you can't use all the residential clean energy credit in 1 year, you can carry the excess forward.
Let's talk electric vehicles or clean vehicles. Credits for buying those.
Yes, two main ones here as well. For new clean vehicles, there's the clean vehicle credit, potentially up to $7,500.
Potentially.
Right. It often breaks it down into two parts, like $3,750 based on meeting critical mineral sourcing requirements for the battery, and another $3,750 for meeting battery component manufacturing requirements. Plus, the vehicle has to meet final assembly rules and price caps.
Are there income limits for the buyer?
Yes, modified AGI limits apply. If your income is too high, the credit is reduced or eliminated.
What about used EVs?
There's a credit for those too, the previously owned clean vehicle credit. It's 30% of the sale price, up to a maximum credit of $4,000.
Any catches?
The vehicle price has to be $25,000 or less. It has to be at least 2 model years old, and the buyer can't have claimed this credit in the prior 3 years. And again, there are MGI limits for the buyer. These aim to make EVs more accessible.
Okay, one last individual credit. The Savers credit. Who's that for?
It's specifically designed to encourage retirement saving by low and moderate income taxpayers.
How does it work?
It's a credit based on the first $2,000, $4,000 if married filing jointly. You contribute to an IRA or employer-sponsored retirement plan, like a 401k.
And the credit amount varies.
Yes, the credit rate can be 50%, 20%, or 10% of your contribution, depending on your AGI and filing status. The lower your income, the higher the percentage. So the maximum possible credit is $1,000 for single filers, 50% of $2,000, or $2,000 for joint filers, 50% of $4,000.
Is eligible.
You have to be 18 or older, not claimed as a dependent on someone else's return, and not a full-time student. It's a nice boost for retirement savings for those who need it most. All right, let's shift gears now to the alternative minimum tax, the AMT. It's kind of a parallel tax system.
Right, the AMT, why does it even exist? What's the point?
The basic idea behind the AMT is to make sure that taxpayers with high economic income pay at least some minimum level of tax.
Even if they have lots of deductions and credits under the regular system.
Exactly. It acts as a sort of backstop, preventing people from using too many tax breaks or preferences to wipe out their entire tax liability. It aims for a measure of fairness at higher income levels.
So how do you actually figure out if you owe AMT? What's the process?
Well, you start with your regular taxable income. Then you have to add back certain deductions or income exclusions that are allowed for regular tax but not for AMT. These are called adjustments and tax preferences.
Okay.
That gets you to your alternative minimum taxable income, or AMTI. From that AMTI, you subtract an AMT exemption amount, which also depends on your filing status and phases out at higher incomes. The result is then taxed at special AMT rates. That gives you your tentative minimum tax. Finally, you compare that tentative minimum tax to your regular income tax. If the tentative minimum tax is higher, you pay the difference as AMT on top of your regular tax.
You mentioned adjustments and preferences. Can you give some examples? What gets added back?
Sure. Common adjustments include things like the standard deduction, if you took it. Certain itemized deductions are treated differently. For instance, the deduction for state and local taxes, SALT, is effectively disallowed under AMT currently. Depreciation on some assets might be calculated differently too.
And preferences.
Preferences are items that get special treatment under regular tax. A classic example is tax-exempt interest from certain private activity bonds. It's tax-free for regular tax, but potentially taxable for AMT. Another might be the excluded gain from selling certain qualified small business stock. Adding these back broadens the income base for the AMT calculation.
Okay, so once you have the AMTI and subtract the exemption, what are those AMT tax rates?
For 2024, there are basically two rates. There's a 26% rate on AMTI up to a certain threshold, around $230,650 for 2024, but check specific year figures, and then a 28% rate on any AMTI above that threshold.
And you compare the tax calculated with those rates to your regular tax.
Precisely. If the AMT calculation results in a higher tax than your regular tax calculation, the difference is the AMT you owe.
What if you paid AMT in a previous year? Does that just disappear?
Not necessarily. There's something called the AMT credit. If you paid AMT in a prior year, you might be able to claim a credit against your regular tax in future years.
How does that work?
It essentially relates to AMT paid because of timing differences. These are items like certain depreciation methods or incentive stock options, where the timing of income or deductions differs between the regular tax system and the AMT system. The credit helps prevent you from being taxed twice on the same income over time just because of these timing issues. It doesn't usually apply to AMT paid because of exclusion items like SALT deduction add back.
Okay. Given all this complexity, are there ways to plan around the AMT, maybe minimize its impact?
Yes, there are strategies. A lot revolves around timing. Since certain income and deductions are treated differently, strategically timing when you recognize them can sometimes help.
Like delaying certain deductions into a non-AMT year or accelerating income.
Potentially, yes, or vice versa, depending on your situation. For example, maybe managing when you pay state and local taxes, if possible, or timing the exercise of incentive stock options. Also, considering the AMT impact when making investment choices, maybe avoiding those private activity bonds if AMT is a concern.
Anything else?
Maximizing deductions that are fully allowed under AMT can also help. Things like charitable contributions, subject to limits, and qualified home mortgage interests generally reduce both regular taxable income and AMTI. So careful planning around these timing and deduction issues can definitely help manage potential AMT liability. Okay, let's move on to property transactions. This covers selling or disposing of assets, tangible or intangible. Understanding gain, loss, and basis is fundamental here.
Right. So if I sell something, say stock, or a piece of equipment, how do I figure out the tax impact? What's the first step?
The first concept is realization. A realization event happens when you sell, exchange, or otherwise dispose of property. Once that happens, you calculate your realized gain or loss.
How's that calculated?
It's simply the amount realized from the sale minus your adjusted basis in the property.
Okay, break those down. What's the amount realized?
Amount realized is everything you get in return. Cash, obviously, but also the fair market value, FMV, of any other property you receive, like if you trade, plus any of your debts the buyer takes over, like a mortgage.
Yeah.
Then you subtract your selling expenses, commissions, advertising, things like that.
Got it. And adjusted basis, that's not just what I paid for it, right?
Usually not, especially if you've held it for a while. Your original basis is typically your cost, but then it gets adjusted over time. You increase basis for capital improvements like adding a room to a house. You decrease basis for things like depreciation deductions you claimed, any casualty loss deductions taken, or certain tax-free distributions from corporations. So it's original cost plus additions minus subtractions.
Okay, cost plus improvements minus depreciation, basically.
In many cases, yes, that's the adjusted basis.
So amount realized minus adjusted basis equals realized gain or loss. Is that the amount that goes on my tax return?
Not necessarily. That's the realized gain or loss. The next step is determining the recognized gain or loss. That's the amount you actually report as income or claim as a deduction.
Are they often different?
Usually, the entire realized gain or loss is recognized, but the tax code has lots of exceptions where recognition might be deferred, like in a like-kind exchange, or where a loss might be disallowed altogether.
And our loss is typically not recognized.
A big one is losses on the sale of personal use assets. Sell your personal car or furniture for less than you paid. Tough luck. Generally, no deduction for that loss.
But if I sell them for more than I paid?
Then the gain is usually taxable. Gains on personal use assets are recognized. The main exception for deducting personal use losses is if the loss is from a casualty or theft, and even then, there are specific rules and limitations.
Okay, that makes sense. Let's go back to basis. You said it's usually cost. What are some key exceptions?
One is a bargain purchase. Say your employer sells you company stock worth $100 for only $60 as compensation. Your basis isn't $60. It's a fair market value of $100 because that difference was essentially income to you.
Okay. What if I buy a bunch of assets together for one price, like buying a business?
That's a lump sum purchase. You have to allocate the total purchase price among all the individual assets acquired, land, building, equipment, goodwill, etc., based on their relative fair market values at the time of purchase. You need that allocated basis for each asset later on for depreciation or if you sell them separately.
How about stock dividends? If I get extra shares, but don't pay tax on them.
Right. For a non-taxable stock dividend, you don't get a basis in the new shares separate from the old ones. Instead, you reallocate the total basis you had in your original shares over the total number of shares you now own, old plus new. So your basis per share goes down.
Okay. What about gifts? If someone gives me property, what's my basis? It can't be zero.
Correct. That would be unfair. Gift basis is a bit tricky. The general rule depends on whether the property's fair market value, FMV, at the time of the gift, was higher or lower than the donor's adjusted basis.
Case 1. FMV is higher than donor's basis.
Then your basis for any purpose, gain, loss, depreciation, is the same as the donor's adjusted basis. It's a carryover basis. You also tack on the donor's holding period.
Case 2. FMV is lower than donor's basis at the time of the gift.
This is the tricky one. You get a dual basis. For calculating a future gain if you sell it, your basis is still the donor's higher adjusted basis, carryover. But for calculating a future loss, your basis is the lower FMV at the date of the gift.
Wait, so the basis depends on whether I sell it for a gain or a loss. What if I sell it for a price between those two numbers?
Exactly. If your sale price falls between the donor's basis for gain and the FMV at gift for loss, then you recognize no gain or loss. It falls in a neutral zone.
Okay. And holding period in that loss scenario.
If you use the FMV basis for live calculation, your holding period starts when you received the gift. If you use the donor's basis for gain calculation, you tack on the donor's holding period. And for depreciation, you always use the gain basis, the donor's adjusted basis.
Is there an adjustment for gift tax paid?
Yes, if the donor paid gift tax, your basis can be increased, but only by the portion of the gift tax attributable to the appreciation in the property, the excess of FMV over the donor's basis at the time of the gift.
Okay, now inherited property. How is basis determined there? Is it carryover like gifts?
No, inheritance is usually much simpler and often more beneficial. The general rule is that your basis in inherited property is its fair market value, FMV, on the date of the decedent's death.
So a step up in basis if the property appreciated.
Usually, yes, or a step down if it lost value. This FMV at death basis rule applies regardless of what the decedent originally paid or their adjusted basis. It wipes the slate clean, in a sense.
Is there an alternative to the date of death value?
Yes. The executor of the estate can elect the alternate valuation date, which is 6 months after the date of death. If elected, the FMV on that date becomes the basis. But they can only make this election if it reduces both the total value of the gross estate and the estate tax owed.
And holding period for inherited property.
Always considered long-term, no matter how long the decedent or the beneficiary held it. That's a nice bonus.
Are there exceptions to this step up, step down rule for inherited property?
The main one is for income in respect of a decedent, or IRD. This is income the decedent earned or was entitled to before death but wasn't taxed on yet, like funds in a traditional IRA or unpaid salary. IRD items do not get a step up in basis. The beneficiary who receives the IRD payment inherits the decedent's basis, often zero, and pays income tax when they receive it.
Okay, let's talk about when realized losses aren't allowed. You mentioned personal use assets. What else?
A big category is sales between related parties.
Who counts as related?
Family members like spouses, siblings, parents, grandparents, children, grandchildren. Also, transactions between an individual and a corporation they control, usually 50% ownership, or similar relationships involving partnerships or trusts. The rules are specific.
So if I sell stock at a loss to my sister,
That loss is disallowed for you. You can't deduct it.
is the loss just gone forever?
Not quite. If your sister later sells that same stock to an unrelated person at a gain, she can use your previously disallowed loss to offset her gain, but only up to the amount of her gain. Her basis in the stock is what she paid you, and her holding period starts when she bought it. This loss offset doesn't work for personal use property, though.
Okay. What about wash sales? Heard that term with stocks.
Right. A wash sale happens if you sell stock or securities at a loss, and then within 30 days before or 30 days after that sale, a 61-day window total, you buy substantially identical stock or securities.
So selling XYZ stock for a loss on June 1st and buying XYZ stock back on June 15th.
Exactly. The loss on the June 1st sale is disallowed in that year.
Again, is the loss wasted?
No. The disallowed wash sale loss is added to the basis of the new shares you've bought. So you'll effectively recognize that loss later when you eventually sell the new shares. And the holding period of the old shares tax onto the new shares.
What if I sell 100 shares at a loss but only buy back 50 shares?
Then only the loss on 50 shares is disallowed and added to the basis of the new 50. The loss on the other 50 shares is recognized currently. These rules don't apply to dealers, usually, and they only apply to losses, not gains.
One more. Converting personal property to business use. What if I later sell it at a loss?
If you convert personal property, like a car or computer, to business or rental use, and its FMV at the time of conversion is less than your adjusted basis, you have a special basis rule for calculating a future loss. For calculating a loss on sale, your basis is that lower FMV at the time of conversion. This prevents you from deducting the decline in value that happened while it was still personal property. This lower basis is also used for calculating depreciation for loss purposes. For calculating a gain, however, you still use your original adjusted basis, plus minus adjustments since conversion.
So another dual basis situation, potentially.
Kinda, yeah. One basis for gain, potentially a different lower basis for loss. And depreciation taken after conversion reduces both potential bases.
Okay. Wrapping up property. Key planning takeaways.
Definitely understand basis, especially the step up for inherited property. That's huge for planning. Be aware of the gift versus sale implications when transferring property to family. And always watch out for those loss disallowance rules. Related parties and wash sales are common traps. Knowing the rules helps avoid surprises. Okay, last section, tax withholding and payment procedures, making sure the government gets its money throughout the year.
Right. Let's start with employers. What are their main duties for employee taxes?
Employers wear several hats here. They have to withhold federal income tax from employee wages. They also have to withhold the employee's share of FICA taxes, that's Social Security and Medicare.
And they pay taxes too.
Yes, they have to match the employee's Social Security and Medicare contributions, and they pay IFUTA tax, federal unemployment tax, based on employee wages. It's a whole system to collect taxes as income is earned.
What are the FICA rates for 2024?
For the employee, it's 6.2% for Social Security, but only on wages up to $168,600 for the year, and 1.45% for Medicare on all wages, no limit there.
What if I work 2 jobs and pay too much Social Security because my total wages go over the limit?
Good question. If that happens, the excess Social Security tax withheld is treated as a payment on your tax return, so you get it back as a refund or credit.
How does the employer know how much income tax to withhold?
That depends mainly on the Form W-4 the employee fills out. That tells the employer your filing status, number of dependent allowances, and if you want extra withheld. The employer uses that info with IRS tables to calculate the withholding for each paycheck.
And then we get a W-2 at year end.
Exactly. By January 31st, employers must give employees a Form W-2 showing total wages, income tax withheld, and FICA taxes withheld for the previous year. You need that W-2 to file your return.
What's backup withholding?
That's when a payer, like a bank paying interest or a company paying a contractor, has to withhold tax, usually 24%, because the recipient didn't provide a correct taxpayer ID number, like a Social Security number. It's a fallback mechanism.
Okay, what about people who don't have taxes withheld? Self-employed people or those with lots of investment income?
They generally have to pay estimated taxes. This is how you pay income tax and self-employment tax throughout the year if you don't have an employer doing it for you.
Who needs to pay estimated taxes?
Generally, if you expect to owe at least $1,000 in tax for the year and your withholding won't cover enough of your total expected tax liability.
How much is enough?
You usually need your withholding and estimated payments to total the smaller of 90% of the tax you'll owe for the current year, or 100% of the tax you owed for the prior year.
Is there a catch for higher incomes?
Yes. If your prior year adjusted gross income, AGI, was over $150,000, $75,000 if married filing separately, that 100% rule becomes 110%. You need to pay 110% of last year's tax to use that safe harbor.
What do these payments do?
They're typically due quarterly, April 15th, June 15th, September 15th, and January 15th of the next year.
What happens if you don't pay enough?
You can face an underpayment penalty, which is basically interest on the amount you should have paid for the time it was unpaid. The rate changes based on market interest rates. Planning is key to avoid that.
Let's talk self-employment tax specifically. Who pays it and what are the rates?
If you have net earnings from self-employment of $400 or more, you generally owe self-employment tax. This covers both Social Security and Medicare contributions for yourself.
What are the 2024 rates again?
It's 12.4% for Social Security on net earnings up to that same $168,600 limit, plus 2.9% for Medicare on all net earnings. That totals 15.3%.
Ouch, that's double the employee rate.
Well, yes, because you're paying both the employee and employer halves. But there are a couple of adjustments. First, you calculate the tax on only 92.35% of your net self-employment earnings. That accounts for half the tax rate itself. Second, you get to deduct 1/2 of your actual self-employment tax paid as an adjustment to income on your Form 1040. That helps offset the burden somewhat.
Okay. Lastly, I've heard about extra Medicare taxes for higher earners. What are those?
Right. There are 2 potential extra layers on top of the regular Medicare tax. First is the additional Medicare tax.
How much is that?
It's an extra 0.9% tax on wages and self-employment income above certain thresholds.
What are the thresholds?
$250,000 for married filing jointly, $125,000 for married filing separately, and $200,000 for everyone else. Note that employers only start withholding this extra 0.9% on wages over $200, regardless of your filing status. So you might need to pay extra via estimated taxes if you're married filing jointly and earn over $250K combined.
Okay, 0.9% on earnings above the threshold. What's the second extra tax?
That's the net investment income tax, or NIIT. This one is different. It's 3.8% and applies to certain investment income.
Which income?
Generally includes things like interest, dividends, capital gains, rental and royalty income, income from passive activities. It doesn't usually apply to wages or active business income.
And who pays the NIT?
It applies if your modified adjusted gross income, MAGI, is over those same thresholds. 250K MFJ, 125K MFS, 200K others. The 3.8% tax is charged on the lesser of your total net investment income or the amount your MAGI exceeds the threshold.
So it hits investment income for higher earners.
Exactly. Both the 0.9% additional Medicare tax and the 3.8% IIT are layered on top of other taxes for those above the income thresholds.
Wow, okay. We've covered a lot today, from the purpose and types of tax credits through business and individual credits, the complexities of AMT, the details of property basis and transactions, and finally, how taxes get paid through withholding and estimates.
It's definitely a dense landscape, but understanding these pieces is really crucial for navigating the tax system effectively.
Absolutely. Having a grasp on credits, basis, AMT triggers, and payment rules really empowers you to make smarter financial decisions. Thanks for joining us on this deep dive.
Hopefully, this discussion provided some valuable clarity on these important tax topics.
We'll explore another fascinating area with you next time.